Although frequently regarded as the economic superpower of the world, the United States is not impervious to financial instability and economic recessions. Over the course of its existence, the country has encountered a multitude of economic downturns, every one of which has significantly impacted its socioeconomic fabric. The phrase economic crisis elicits a multifaceted network of interconnected elements, including, but not limited to, housing market distress, unemployment spikes, market volatility, and pervasive financial uncertainty. Crises throughout the annals of American economic history have exhibited diverse manifestations and sources of origin. However, they are united by the characteristic of instigating extensive apprehension, disarray, and panic among the populace. These crises, which have been precipitated by internal financial imbalances, global economic shocks, or systemic failings in the financial sector, have put the American people and economy's resilience to the test. An economic crisis is frequently initiated by a series of interconnected occurrences that have far-reaching consequences throughout multiple sectors of the economy, causing significant disruptions in financial markets, businesses, and households. The underlying turmoil is starkly indicated by stock market collapses, banking panics, and soaring unemployment rates. In the meantime, ordinary Americans contend with the unpredictability of their financial futures. In the midst of turbulence, when businesses and individuals alike encounter the harsh realities of economic uncertainty, a sense of panic may grip the nation. Communities are consumed by concerns regarding potential job losses, foreclosure threats, and diminishing savings, which amplify anxieties and motivate individuals to resort to extreme measures in order to ensure financial stability. The potential for economic recessions to occur has a profound impact as it undermines the trust of investors and consumers and alters the nature of policy discussions and public dialogue. The manner in which policymakers, businesses, and civil society react following such crises is critical in determining the trajectory towards recuperation and revitalization. In order to accomplish this and establish a foundation for long-term resilience, monetary and fiscal interventions, regulatory reforms, and social safety nets are implemented. However, economic crises frequently result in lasting consequences that transform social dynamics, reshape economic frameworks, and shape the collective consciousness of the country. Amidst the intricate dynamics of the contemporary global economy, the United States perpetually confronts the imminent possibility of an economic crisis, which serves as a poignant reminder of the precarious nature of striving for prosperity. Gaining a comprehensive understanding of the origins, dynamics, and repercussions of these crises is crucial not only for preventing future disruptions, but also for cultivating a more profound recognition of the interdependence of economic forces and the fortitude of the American people in challenging circumstances. The following is a synopsis of the fundamental elements that are commonly noted during an economic crisis in the United States. 1. Financial market turmoil. Stock markets frequently experience significant declines during periods of economic crisis in the United States, which leads to financial market turmoil. These economic contractions precipitate significant financial losses for investors, in turn instigating a cascading impact throughout the entire economy. The erosion of consumer and business confidence precipitates a pervasive sense of apprehension regarding financial futures as investments diminish. The precipitous decline in stock prices functions as a conspicuous manifestation of economic instability, compelling both enterprises and individuals to reevaluate their investment and spending approaches. The prevailing apprehension regarding the maintenance of financial recessions exacerbates the predicament. 2. A surge in unemployment. In the United States, economic recessions frequently result in a substantial surge in unemployment rates, driven by the implementation of business closures and cutbacks as a means of mitigating financial losses. The current upsurge in unemployment has extensive ramifications, profoundly impacting both individuals and families. Individuals who experience sudden unemployment are confronted with immediate financial hardship, frequently encountering difficulties in procuring essentials like shelter, healthcare, and sustenance. The stress is exacerbated by the unpredictability associated with their means of subsistence, which induces anxiety and apprehension regarding the future. Families may experience substantial transformations in their way of life and financial objectives as they confront the difficulties of unemployment and the pursuit of fresh prospects. 3. Housing market distress. Had economic crises ensue in the United States, the housing market frequently undergoes a period of distress marked by escalating foreclosure rates and a precipitous decline in home prices. Numerous homeowners encounter the formidable circumstance of being insolvent on their mortgages, delinquent in payment beyond the appraised value of their properties. A wave of foreclosures is fueled by this disparity, which exacerbates housing instability throughout communities. Families might be confronted with the imminent peril of home foreclosure, which would further compound the strain on an already arduous economic terrain. The housing market distress has far-reaching consequences that affect various aspects of the economy, including financial institutions, consumer confidence, and the overall stability of the housing sector. 4. A credit crunch. In the United States, credit crunches frequently occur during economic downturns due to the tightening of lending standards by financial institutions and banks, which limits access to credit. The aforementioned tightening poses a growing obstacle for enterprises seeking to obtain loans for the purposes of expansion and investment. A decline in credit accessibility further exacerbates economic deceleration, impeding the expansion potential of enterprises spanning multiple industries. It may be difficult for businesses to innovate, expand operations, or even sustain current business activities if they have restricted access to capital. The credit shortage has a cascading impact on the economy as a whole, exacerbating the difficulties that individuals and businesses encounter in attempting to navigate the crisis. 5. Government intervention. Intervention by the government is of the utmost importance in stabilizing the economy during economic crises in the United States. Monetary and fiscal policies are frequently employed by the government in an effort to alleviate the effects of an economic downturn. Potential measures encompass the Federal Reserve's implementation of interest rate reductions to incentivize borrowing and spending, stimulus packages designed to infuse funds into the economy, bailouts of financially troubled institutions intended to avert a systemic collapse, and infrastructure spending intended to foster demand and employment generation. The objective of these interventions is to reinstate confidence, stimulate economic activity, and mitigate the challenges that individuals and businesses are experiencing. By means of effective governmental intervention, the crisis's severity can be diminished and a more resilient and sustainable recovery can be established. 6. Consumer and business confidence. Uncertainty frequently instigates a decrease in consumer and business confidence in the United States during economic crises. When confronted with financial uncertainties, both businesses and individuals exhibit a tendency to curtail their expenditures, steering clear of investments in expansion or innovation. The economic downturn is further intensified by this prudent strategy, given that reduced business investment and consumer expenditure contribute to a decline in aggregate demand. A contraction in overall economic activity, additional unemployment, and decreased production are all potential outcomes of this downward spiral. The economic recovery hinges on the restoration of consumer and business confidence, given that increased investment in spending can stimulate demand, promote development, and generate employment and expansion opportunities. The dissemination of government policies and initiatives in an effective manner can facilitate the restoration of confidence and foster economic resilience. 7. Social impact. The social ramifications of economic crises in the United States are frequently extensive, intensifying issues such as social unrest, poverty, and inequality. Vulnerable populations, including those with low incomes and marginalized communities, are disproportionately affected by the crisis. They encounter increased obstacles when attempting to obtain vital services and support systems. The exacerbation of pre-existing social divisions occurs as disparities in opportunity and wealth expand in tandem with heightened levels of unemployment and strain on social safety systems. Social unrest can be incited by the exasperation and discontent that ensue, as evidenced by the demonstrations and protests that highlight grievances regarding economic injustice and inequality. It is vital to address the social repercussions of economic crisis in order to build a more resilient and inclusive society. As a consequence of these obstacles, both communities and individuals may undergo increased episodes of anxiety, tension, and panic. Fear and uncertainty may permeate the populace due to apprehensions regarding employment security, financial stability, and the trajectory of the economy as a whole. It is crucial that the government, businesses, and individuals collaborate during economic downturns to address the root causes of the downturn and implement policies and strategies to mitigate its effects. This may entail endeavors to restore stability to financial markets, facilitate the establishment and maintenance of employment, furnish social safety nets for individuals most impacted, and foster enduring economic sustainability and resilience. Through collaborative efforts, the trajectory toward recuperation and revitalization can be set. However, the aftermath of economic crisis often leaves lasting consequences, transforming social dynamics, reshaping economic frameworks, and shaping the collective consciousness of the nation. As the United States grapples with the ever-present specter of economic downturns, a profound understanding of their origins, dynamics, and repercussions becomes paramount. Such understanding not only aids in averting future disruptions, but also fosters a deeper appreciation for the interdependence of economic forces and the resilience of the American people in challenging times. Thanks for watching. Do not forget to like and subscribe to our YouTube channel.